Is it better to invest in property or shares? Both are proven paths to build long-term wealth, but they also come with their own pros and cons as well. We'll weigh up the key factors to consider to hopefully help you decide which investing approach is right for you. The most obvious difference between investing in property and shares comes with diversification. Diversification means spreading your investments across different asset classes to help you mitigate risk. So, if one of your asset classes completely crashes, it means you haven't lost your entire portfolio. Diversification is relatively easy in the share market. You can invest in all sorts of companies, industries and sectors and spread your investments however you like. You can even invest in ETFs or exchange traded funds, which can diversify your portfolio with one single purchase. Check out our intro to ETFs up here if you haven't watched that video already. With property, you are much more limited with your diversification options. You can diversify across different states, suburbs or property types perhaps, but ultimately your investment will still be tied to the performance of one asset class only in real estate. The next major difference in investing in property and the share market comes when looking at costs. Unfortunately, with property, there are several big upfront costs to pay before you can get a foot in the door. Property isn't cheap and you'll need some sort of a deposit. Then there's stamp duty, conveyancing fees, building inspections, mortgage insurance. These can all add up easily to tens of thousands of dollars. There's also ongoing costs to consider such as council rates, building maintenance and property management fees. Then there's another round of costs with selling the property down the track as well. Investing in the share market is far more accessible in terms of cost. Online brokers such as Perla or SelfWealth charge just $9.50 in brokerage per trade, which is all you really need to begin your investing journey with as little or as much money as you like. You can check out our SelfWealth referral link in the description below if you're interested. It gives you 5 free trades to get started with. I'll also get 5 free trades as well, just for full disclosure. Another point is there's obviously no physical asset to maintain with shares, unlike with property. If you choose to invest in ETFs, there is a very small management fee involved, but these are all generally below 1%, with some as low as 0.1%. If you've stuck with us this long, thanks heaps for watching. It helps us out massively if you can just leave a quick like on the video. Feel free to subscribe as well for more fun personal finance content. Another point to consider is the role of debt. With property, unless you have a significant amount of money to start with, you'll need to take on a significant debt in the form of a mortgage. If things go well, you can continue to leverage more and more debt through the equity or value of your properties to buy even more properties. But again, you need to be comfortable in taking on a large amount of debt to build this long-term wealth. With the share market, there's no need to take on any debt at any stage. You can build a portfolio using your normal savings. There are options to use leverage to further amplify investments in the share market, but most everyday investors probably won't bother with this approach. The final point is around the flexibility of both investments. There is far more liquidity when investing in the share market. If you need to quickly access your money in an emergency or for some other reason, you can simply sell down some of your shares and have that money hit your bank account within a day or so. On the other hand, it is far more difficult and time-consuming to access your wealth when it is tied to property. Your funds are linked to a physical asset, and you can't quickly just decide to sell part of a house in an emergency situation like you can with shares. There are some advantages to this though. Having a physical asset such as property means you can tangibly improve the asset to create additional equity or wealth. So you can renovate or subdivide, for example, to try and add value to your investment. You also have a roof over your head. So even if the investment itself isn't quite going to plan, you still have that last line of security for you and your family, which is another thing to consider. On the flip side, you can't really renovate or live in your shares. They only exist on paper. So that's our quick look at things to consider when deciding to invest in either property or shares. You need to weigh up your diversification, upfront and ongoing costs, the role of debt, and the flexibility of both investments as you plan your own strategy. There's plenty of other factors in play too, but in the end it comes down to your own personal circumstances, your own risk tolerance, and what your long-term goals are. Thanks for watching, hope you got something out of that, and we'll catch you in the next video.